So let's talk about the end of 2023. If you were just looking at crypto prices, you'd probably think the whole thing was crashing and burning. But what if I told you that under the surface, a totally different story was playing out? That's what we're going to dive into today. This great disconnect between what the market price says and what people were actually doing with crypto. All right, so just to set the scene for you, in the last 3 months of 2023, the price of Ethereum, a huge pillar of the crypto world, it just plummeted. We're talking a staggering 29% drop. All the headlines were screaming doom and gloom, everyone felt bearish, and it really looked like we were heading into another long, cold crypto winter. And this is where things get interesting. This is the central paradox we're talking about. There's this great quote from Matt Haugen at Bitwise that says, "Markets often bottom when participants lose interest just as adoption quietly improves." And that right there just nails what was happening. While all the traders were getting bored or scared and looking away, the people actually building and using this stuff were more active than ever before. It's a huge disconnect. Okay, so first, let's just quickly look at that gloomy story, the one the price charts were telling everyone at the end of the year. Man, the end of 2023 was just a total roller coaster, wasn't it? I mean, in October, Bitcoin rocketed to an insane new all-time high of nearly $126,000. But that party did not last long. A massive correction hit, and by the time the year was over, $1 trillion with a T had vanished from the total crypto market cap. That's the picture of a market that's pulling back big time. So this all leads to the big question, right? Is price the only thing we should be looking at? Is that the whole story? Or was there something deeper, something more fundamental going on that the price charts just weren't showing us? And the answer is a huge, resounding yes. To really get the picture, you have to stop looking at the market price and start looking at what's happening on the blockchain. That's where the real story of 2023 was being written. So the key metric we need to wrap our heads around is something called on-chain revenue. And it's actually pretty simple. Think of it as the total amount of money users are willing to pay in fees just to use a blockchain or an app. It's a super direct way to measure how much demand there is for these services. You could almost call it the GDP of the crypto economy. Okay, now get this. While prices were in a nosedive, users paid almost $20 billion in on-chain fees in 2023. Let me say that again. That's not a drop. That is a 35% increase year over year. People were literally paying more than ever to actually use this technology. So you're probably wondering, where was all this fee revenue coming from? Well, the engine room was pretty clear. A whopping 63% of those fees came from DeFi, decentralized finance apps. And this isn't just people gambling on coins. This is people paying real money to trade, to lend, to borrow, all on chain. It's proof of genuine, sustainable demand. All right, let's go a layer deeper. What exactly was driving this incredible on-chain boom? Two things really jump out: stablecoins and decentralized exchanges. I mean, stablecoins just had a massive year. Their total market cap soared past $300 billion. And get this, 46 times trillion dollars in transaction volume. Trillion. That is not some tiny niche crypto thing. That's the foundation of a new global financial system being built right before our eyes. And all that usage, it translated into real hard cash. Tether, the company behind USDT, raked in $5.2 billion in revenue. The Tron blockchain, which is like a superhighway for stablecoin transactions, earned $3.5 billion. We're talking about real profitable businesses here, built on providing actual utility, not just selling hype. So take a look at this chart. It really shows you just how essential stablecoins are. See that tight correlation? As trading volume for other crypto assets goes up, stablecoin volume goes up right with it. It's because stablecoins are the plumbing. They're the digital dollars that make the whole ecosystem work. You can't have one without the other. But wait, there's more. This story isn't just about stablecoins. It wasn't just about what people were trading, but where they were doing it. And in 2023, we saw a huge fundamental shift in the market, one that hints at where all of this is headed. For the longest time, right, big centralized exchanges like Coinbase or Binance were, well, they were the only game in town. If you wanted to trade, you went to them. But in 2023, decentralized exchanges, DEXs, just exploded onto the scene. Just look at these numbers from August. The total daily volume on all DEXs was almost 4 times bigger than a giant like Coinbase. That's a massive signal that people are moving towards holding their own keys and trading directly on-chain. And this single number here really drives the point home. The ratio of DEX volume to CEX volume hit a brand new all-time high. And look, this isn't just some random spike. This is a fundamental change in how people are choosing to interact with crypto. It's a vote of confidence in a more decentralized way of doing things. So when you add it all up, the record-breaking fees, the explosion in stablecoins, the huge shift to DEXs, it all points to one very, very important question. And this slide, this really says it all, doesn't it? It's a tale of two completely different worlds. On one hand, you've got the market metrics, market cap, ETH price, and they're bleeding. They're way down. But on the other hand, you have the actual usage metrics, stablecoin supply, on-chain fees, and they're not just up, they're hitting all-time highs. Two completely different stories being told at the same time. And here's the real kicker. This isn't the first time we've seen this movie. The last time we saw this exact same pattern, prices falling while real usage was climbing, was right around the beginning of 2023. And what happened next? A 2-year-long massive bull run. So history tells us that this kind of disconnect isn't a sign the market is broken. It might actually be a sign that it's found a bottom. So what are we supposed to make of all this? What's the big takeaway for the future? Well, it really boils down to this. The myth is that falling prices mean crypto is dead. But the reality is that fundamental usage and real economic activity on-chain hit all-time highs in 2023. What we might be seeing here is crypto finally growing up, moving away from being just a speculative casino and becoming actual useful infrastructure. And if that's true, this whole decoupling thing could be an incredibly bullish signal for the long term, no matter what the price does tomorrow. So I want to leave you with one final, really interesting question to think about. For years, it felt like price drove everything else. Hype would drive up the price, and then users would follow. But now, it feels like that's flipped. It feels like real adoption is happening first. So what do you think? Is all this fundamental on-chain activity eventually going to drag the market price up with it? Or can they stay disconnected forever? I'd love to hear your takes, so drop a comment below. Thanks for tuning in.